Hello and welcome to today's technical webinar on SIPP versus SAS. My name's Lisa Webster and I'm Senior Technical Consultant here at AJ Bell. So on the agenda today then, I'm going to start by looking at SAS basics, then I'll have a little look at group SIPP versus SAS. So, if you've got a couple of members coming together, which option might be best. I'm then going to have a look at why SAS. So that's sort of the specific things that you can do with the SAS that you can't do with the SIPP. And then I'll finish off with a look at transfers and takeovers, so transferring in and out of SAS takeovers, what you do, how that works a little bit differently. I am sort of working from the starting point that most people listening to this will have a pretty good idea about SIPPs. So really focusing on what makes SAS different and then sort of comparisons in sort of particular scenarios. So I'm going to start off with the SAS basics then. So a SAS is a small self-administered scheme, that's what it stands for, with a maximum of 11 members. So sometimes you might see 12 members quoted, and that's down to the fact in the legislation it actually references 12, not 11, because it says that it is for a small self-administered scheme, is a scheme with fewer than 12 members. Therefore, the maximum is 11. They are normally, but not always, directors or senior management of a business. That's sort of the most common scenario of who will set up a SAS. It is importantly an occupational scheme, which means it is established by the employer. So a SIPP is a personal pension, self-invested personal pension, clues in the name. And if you join a SIPP, it's normally a scheme that's well established, and then you are joining an existing scheme. Normally, it's a master trust, and then you have people that join arrangements underneath that master trust. So the scheme's already established by the provider, and so the setup process is quite quick. You can sort of set up, join the SIPP, and make contributions, transfers in straight away. With an occupational scheme, with a SAS, it is different because it is the employer that establishes it, not the provider. Even if you have a recognised pension provider who is trustee administrator, which I'll come on to, they don't establish the SAS. It is the employer that establishes it. And the employer can be a variety of different types of entities. The key thing is that they employ somebody to be classed as an employer. So most commonly, we will see that it's a trading company is the sponsoring employer on a SAS, by far and away the most common. But it can be an investment company. You can have a partnership, that's like a traditional partnership or an LLP structure. You can even have sole traders, because sole traders can employ people. So at least they have to have at least one employee, and then they would be eligible to set up a SAS as an employer, and then the scheme could invite that sole trader to join that as well. So the scheme has to be established by an employer for the benefit of its employees, but it can also invite other people to join as well. So you could have schemes where, if you have husband and wife, one of them has their own business, they are an employer, they establish the scheme, they could invite their spouse to join the scheme even if they're not an employee of the company, and other family members as an example. So they don't all have to be employees as long as the scheme is set up for the benefit of employees. Another advantage of having a SAS, and where things are a little bit different, because it's an occupational scheme, the sponsoring employer, so say in most cases the company, has the ability to pay for the fees. So fees don't necessarily have to come out of the scheme. I mean, you can pay fees personally on a SIPP, but normally you'd want it to come out of the SIPP because you put it in, you get tax relief on it. With a SAS, if an employer pays fees in relation to the pension scheme for its employees, that is a tax deductible business expense as well. So it will reduce their corporation tax bill. So it's quite tax efficient for the employer to pay the fees, as well as it is for the scheme to pay the fees. But obviously the advantage is if you have members who are right up to their annual allowance, it means they can put the maximum up to their annual allowance into the pension scheme and pay the fees outside the pension scheme and still get tax relief on it. And obviously that means you get more money into the pension and keep more money within the pension. So that is another sort of advantage of doing that with SSAS. Also, if the company is VAT registered and you pay your SSAS fees and you pay VAT on your SSAS fees, then the company might be able to claim those back as well. Because say the scheme is established by the sponsoring employer, you know, you create, it's a new trustee each time, which means you can actually write slightly different rules in if you want. Not all SSAS rules will be the same, you know. Like with our master trust SIPP, we have one set of rules and, you know, 100,000 members, a couple of 100,000 members now in there. Whereas with this, because, you know, you're only writing rules for the membership of this one specific scheme, you can change the rules slightly as necessary. And I'll come on to a couple of scenarios where you might want to do that. Say it's an occupational scheme, the employer sets it up, but it doesn't mean on a continuing basis that you have to have an employer. So if you set up the SSAS for the company sets up the SSAS for its employees, and, you know, a few years down the line, 10, 20, 30, 40, however many years down the line, the members then sell that business to somebody else, you can remove the link between the scheme and the employer, and the pension scheme can continue. It doesn't mean it has to wound up, it doesn't have to go in the same direction as the company or anything like that. So those original members can carry on with it. So we just remove the link with the sponsoring employer. So there's no big issues with that one. Every scheme, because you are setting up a new scheme each time, every scheme has to be registered separately with HMRC, which does mean it can take a little while. So that's something you definitely need to be aware of if you are considering setting up a SSAS, or your client's company or employer is going to set up a SSAS. It does take some time. Now, this can vary significantly. If you're very lucky, it might only take a few weeks with HMRC. If you're not so lucky, it can take several months. And we have seen quite a lot of delays this year, like a lot of things really, I think, with registrations going through at HMRC, though the situation does seem to have improved a little bit in the last couple of months. I don't know if they've actually put some extra resource on it, because they did have a bit of a backlog with SSAS registrations, but that does seem to be getting a little bit better and things moving along a bit in terms of getting approval. Because in the background, HMRC will obviously review the application that has come in and look at the parties involved, check if they have any concerns with any of them before they will allow the registration of the scheme. So who are those parties then? Who do you have involved in a SSAS? Well, first of all, obviously, saying you're setting up a new trust each time, clearly we need trustees. Since A-Day, there has been no requirement for a professional trustee anymore. So technically from the rules, it's not necessary. People have varying opinions about how right or wrong that is. I'm not going to go into that. All members are usually trustees. If the members are all trustees, then it becomes what's known in legislation as a relevant small scheme. There's lots of reasons why you want it to be a relevant small scheme. Basically, it exempts you from all kinds of extra rules and regulations associated with occupational pension schemes. Things like statement of investment principles, disclosure of charges information, requirement for IGCs, GAAs, governance issues. There's just lots and lots of extra reporting requirements if it's not a relevant small scheme, a lot of extra work. So yes, you really want your members all to be trustees. In terms of who can be a trustee, it's normal trustee rules, i.e. it's got to be somebody who's aged 18 or over, legally capable of holding property, can't have people that are disqualified, people who are convicted of offences, undischarged bankrupts, that kind of thing. So usual trustee conditions on there, kind of somebody who's been disqualified from acting as a company director, etc. on that. The other important party on a SAS will be the scheme administrator. So the scheme administrator is the person that will do the registration initially, and then is responsible for all the reporting to HMRC. And this has to be a fit and proper person or persons. It can be more than one. You can have joint scheme administrators. They're the ones, if the filings and things aren't done correctly with HMRC, you know, this is the party that's going to be liable for them, for fines for not doing things right. The people that aren't going to be considered fit or proper is anybody that doesn't have sufficient working knowledge of the pensions and pensions tax legislation to be fully aware and capable of assuming the significant duties and liabilities of the scheme administrator, or does not employ an advisor with this knowledge. So it's important that the person who's the scheme administrator knows what they're doing, or at very least employs somebody else who knows what they're doing. So with our Platinum SSASs, we are trustee and scheme administrator. We perform both roles because we think that gives us the most control, I suppose, but not just, you know, control like in one way. Yes, we are restricting what people can do with their SAS, but we're only restricting them because we want to make sure they do it right and they don't fall foul of the rules. I think there's a lot of issues in the past with schemes, with SAS schemes, who don't have any professional trustees or scheme administrators on there, who will inadvertently fall foul of the rules. Not necessarily, I mean, there's liberation, which is a whole different issue, but not even talking about that right now. Just it's very easy not, you know, if you don't know what you're doing with it, if you're not experienced in this, to get things wrong and break the rules, or, you know, do something without realizing it and landing yourself, you know, with unauthorized payment charges, late filing notices, all kinds of things, if you don't know what you're doing with it. There are some providers out there that will act as practitioner. They're not trustees or scheme administrator, they will act as practitioner. So, you know, obviously they should have the knowledge still and be able to help people run their SAS correctly. But at the end of the day, they don't have the liability for it unless they're scheme administrator. You know, so if there are fines and somebody gets it wrong, the buck doesn't stop with them. So, you know, by being scheme administrator, you know, we have that responsibility, but make sure that we want to make sure we do it right as well, because, you know, otherwise it's implications for us too. So, you know, other things where reasons can be, scheme administrators can be struck off or not be appropriate. Anything, obviously, anybody who's got any previous involvement in liberation or any schemes that previously been deregistered by HMRC, anything to do with any sort of criminal activity, fraud, tax abuse, tax avoidance, any other scam schemes, or anybody known to HMRC, to the authorities, then they won't meet that fit and proper test. Sometimes we hear this question about, oh, should SAS be regulated, and this view that SAS aren't regulated. SSASs are regulated. They are not regulated by the FCA because they are not personal pensions, they are occupational pensions. So SAS are regulated by the pensions regulator. And if there are 2 or more members in a SAS, then we have to do a registration process, go through a registration process with TPR. So when a scheme is established, where we register it with HMRC, you can't do anything at all. Your scheme doesn't exist until you get that registration back from HMRC. Once you have that registration back from HMRC, you can then make contributions into that scheme. You can apply for transfers, but just want to be aware of, some providers won't let you transfer out for them into a SAS until they have the TPR registration through as well. It is something that a lot of providers will ask for. Obviously, if it's a 1-member scheme, it doesn't apply because it is only 2 or more members when we have to register it with TPR. Sometimes if that is in the process, then they will allow transfers. It depends on where it's coming from, really, and their policy. So just want to be aware of, because certainly setting up a SAS and getting transfers in will take a lot longer than, you know, if you're used to dealing with SIPPs. There is a big difference on the timescales on this. Another thing to consider with SSAS is how you get your tax relief on your pension contributions. So just a quick reminder that there's two main methods of tax relief. So we have the net pay system or the relief at source. So under net pay, all your contributions come from your employer. So both obviously you have your employer contributions, but even personal contributions, they are collected through payroll by the employer before that income is taxed. So that has the advantage that tax relief is automatically given at the highest rate. So if you have people who are higher rate taxpayers, you don't have to do their self-assessment or anything, put it on there. They will get it automatically. Disadvantage is that low earners miss out on tax relief. So those that have earnings below the personal allowance aren't paying tax. They don't get the 20% uplift that you get under a relief at source system. So relief at source is what SIPPs are. A lot of other personal pensions, some occupational schemes, workplace pensions, bit of a mixture. So relief at source is where personal contributions are paid out of your taxed income and the scheme claims back that 20% basic rate tax. So everybody gets that, even if people, non-taxpayers, people who earn below the personal allowance still get that. People, non-earners, can still put in the 3,600 and get that basic rate relief on it. Any higher additional rate relief has to be claimed separately. So there's two different systems. Now, when it comes to SSAS, most SSAS will probably operate on a net pay basis rather than relief at source. In practice, most SSAS contributions are likely to be employer contributions. You're not going to see an awful lot of personal contributions, but it can be a factor, say, especially if they do invite other people, whether it's family members, to join the scheme that aren't employees, then this may be a consideration. Now, technically speaking, a SSAS can be either net pay or relief at source. It's most common for it to be net pay, just because of the extra administration involved at relief at source. Because, again, it's a separate scheme, it would have to register separately for relief at source with HMRC. And if you're then making those personal contributions, then you have to do tax returns and make those claims back from HMRC. And every time you do a claim, every time a contribution goes in, it's then between 7 and 11 weeks for the scheme to get that basic rate tax relief into the scheme. Whereas under a net pay, if you did it under net pay, because you don't pay the tax in the first place, and it's the gross contribution going in, you get that straight away. So just a little difference, which may or may not be relevant. If you're just doing employer contributions, then it's not going to make a big difference to you anyway. So moving on to sort of how the SSAS operates, the big pool that we have. So a SSAS then is one trust, one legal entity for however many members are up to it, anything from 1 up to 11 members. All those investments in there are pooled. You can call your SSAS whatever you like it, because they are individual schemes and they are set up each time. So commonly we will see them with the name of the company, whatever the company name is, Limited SSAS. You can have a family pension trust, Webster Family Pension Trust, if you wanted to. Little insight into my life here when I was writing these slides, trying to think of a random name just to prove you can put whatever you like on it. Pippin and Nibbles, guinea pigs that I share my office with. Little insight into my life. You'll be pleased to know that I'm not featuring on any of my passwords anywhere, so it's not a security risk. But really, yeah, the point is you can call your scheme whatever you like, really. There's no set rules on it because you're setting up the trust on that, so that's fine. Within your SSAS, you have all your assets. So you're always going to have a bank account in there, obviously. You can have several bank accounts in there if you want, different deposit accounts and things. You can have, here we've got a general investment account. We have a DFM in there, and I've put a property in there because it's obviously very common for SSAS to own a commercial property. In terms of the split, the trust itself owns all of those assets. So the ownership between the members will be, obviously, the thing that your scheme administrator will do is keep a record of that. based on contributions transfers in, less any benefits that's going out. So it isn't that, you know, Pippin owns the property and Nibbles owns the general investment account. You know, it's they all own a bit of everything that's in there. Everything is pooled on it. Some advantages on that when it comes to, you know, wanting to take benefits, liquidities, you can take it from wherever is easiest. If you are purchasing a property and you are borrowing to purchase that property, it is one loan from the bank to the SSAS, the entity that is the SSAS. Another advantage on the SSAS is that if you do have a sponsoring employer is cash rich, you can make a loan, you can borrow, instead of borrowing from the bank, you can borrow from the sponsoring employer as well, as long as it's on commercial rates and we have evidence that that is commercial. You can do that as well. Obviously, one of the disadvantages with this and everything being pooled is that all trustees have to agree to everything. Good relations are crucial when it comes to a SSAS. If there are going to be any disputes, you know, you need to have a policy, you know, to how those are dealt with. You know, if somebody wants to sell the property, what happens with death benefits, what happens if somebody leaves the business, you know, if it's business partners that are in it. You need to have agreements up front in place of exactly what's going to happen in those scenarios. Because if you don't, then you can end up with some horrible situations in SSAS when you have disputes between the trustees and you can't get a unanimous agreement. There's disputes that have gone on for years. There are some that ultimately will end up in court. You want to avoid that at all costs. So, you know, the more sort of scenarios you can think of and have agreements for what will happen set out at outset. And I say, if people have, I don't know, less than great relations at times, then probably don't put them together in a SSAS, because yes, they need to agree on things. In terms of people having different attitudes to risk, obviously if everything's pooled, that can create issues. But if your scheme rules allow, and sort of going back to the point at the start, obviously you have, you know, because it's an individual trust that you're setting up each time, you can write it into scheme rules as appropriate. If your scheme rules allow, then you can have notional earmarking of assets underneath the SSAS. So in this example here, they might have come together, have a joint bank account in there, just current transactional account, you've got the property that they're in together, but actually, you know, Pippin has the DFM portfolio with ABC Wealth Management, that's earmarked for him, and then Nibbles has got a general investment account, you know, with his name against it, so there is some notional earmark, and so they can do separate things with it. One of the big advantages of having a SSAS and everything pooled together is when it comes to death benefits, because here, and especially, you know, when you have family trusts and things, is that if you have two members in the scheme, you know, and one of them passes away and the other one is the beneficiary, there's not an awful lot that has to happen. Obviously, the funds still have to be designated to the beneficiary in their name, but if they want to keep the assets in the pension scheme, you don't have to do a transfer out. It's not like with a SIPP, if it's an individual scheme, that you have to transfer it out to the beneficiary in their own name if it's already, you know, they're already a trustee of this scheme. You can also bring in other members, and you can bring in beneficiary members. And beneficiary members don't necessarily have to be trustees. Now, if they're over 18, they can be. Because you can appoint other trustees that aren't members if you wanted to. But you can have, you know, so you could have people that are under 18, for example, you know, especially if there's commercial property in there, you know, they don't need access to the whole asset, to the whole fund, but, you know, they just want to take an income out of it, then they could join as a beneficiary member. You're not having to transfer that property or sell that property. The property is still legally owned by the trust, it's just the underlying members' ownership has changed. But it does make it a lot smoother in those circumstances. Also, there's an element of control. You know, even if you have somebody, you know, who's a young adult, 20, whatever, we quite often get about concerns with death benefits. So it may be tax efficient to pass it on to like grandchildren rather than children, for example. Death benefits, if they, especially if the original member has died over the age of 75, but people are worried about the control, about them having access to the whole fund, you know, straight away, particularly if it's sizable. Whereas if they became a beneficiary member of a SSAS, yes, they still have a right to take benefits, but if there's other trustees in the scheme and all the trustees have to agree, and if they might have other family members that are, you know, looking after their interests, then actually they might say, well, yes, you can take an income from here, but we're not selling the property for you to access the whole capital in one go. You know, there are sort of things like that. You can have a little bit more control with it than maybe under a SIPP. So it can work well for family pension trusts, and they can continue, you know, indefinitely for generations if required. Comparing this to SIPP, so example, if you had two, you have Pippin and Nibbles again, and they were wanting to purchase commercial property and they're looking at the SIPP option. So normally with SIPPs, you have your individual SIPPs. So you both, you know, you have your own arrangement with your own bank account. And here, yes, you've got one of you's got a DFM and one of you's got funds and shares service. That's fine. Now, it is possible with some providers to have what you would call a true group SIPP, as in, so it is a bit more like a SAS structure in terms of everything is pulled together. I think they're not as common as they used to be, but there may be some out there. What a lot of providers do is effectively, it's a group of SIPPs opposed to a group SIPP technically. So you have your separate SIPPs, assets are held separately, and then if they want to come together to purchase a property, then you'll have this bank account. It's a joint bank account effectively between the two pension schemes, where you'll put your money in there and use that to purchase the property which is owned jointly. Effectively, because there is no legal entity really in the middle, it is just a joint bank account. That is actually a bit of the property is owned by each of those SIPPs, is how it works effectively. When it comes to borrowing, if you're borrowing to fund that property purchase, in this instance, it's actually two separate loans, one to each SIPP, which can be secured on the same asset and split accordingly. You know, that is done quite commonly. It's not an issue to do that, but you're just, you know, aware that it is two separate transactions, and then if the rent is coming into that joint account, it then gets divided into the individual accounts. There's a lot more sort of transactions going on. In terms of fees, obviously it will vary depending on the provider and the comparison on it, but you know, roughly speaking, if you have two members, there's probably not a huge difference in fees between doing a two-member group of SIPPs and two members in a SAS, whereas if you have three or more members, then generally speaking, so not always, the SAS may start to look a little bit of a cheaper option, or efficient, however you want to term it, on that. Moving on now to things you can do with SAS that you can't do with SIPP. So loan back is the obvious one, and this is probably one of, if not the main reason why most people, the SSASs are set up, because they have this ability for the scheme to make a loan back to the sponsoring employer. There are strict conditions on it, and these conditions are around security, interest rates, the term of loan, the amount of the loan, and the repayment terms. So I'll look at these each in turn. Starting with security then. Key point is it has to be secured with a first charge on an asset at least equal value to the face value of the loan, including the interest. So first charge, you can't use property that's got a mortgage on it, which does knock it out of the park for a lot of people, unfortunately. In an ideal world, when you're doing a SAS loan back, the perfect asset for a SAS loan back is commercial property owned by the sponsoring employer that doesn't have a mortgage on it. So if that's, you know, if you have clients in that scenario, fantastic, perfect scenario if you're doing a SAS loan back, this security. Obviously, a lot of people don't have that, and so, you know, we do get asked, and you sort of look at, well, what else can you use if you don't have an unencumbered commercial property? And you can look at other assets, and we can look at other assets that would be classed as taxable property, but there are a few other considerations. And you can look at assets. They don't have to be owned by the sponsoring employer. Obviously, SSAS, we are normally talking about the directors, senior management, normally directors of limited companies. They can use assets they own personally, not just owned by the business. But we do need to be careful. So they can use residential property. But a few things to bear in mind. The first one is this security. The security will be called upon if the loan isn't repaid. And people need to be very aware of the fact this isn't just a paper exercise. You know, it is a legal charge. If the company does not pay that loan back, you know, and after negotiations, we can't put repayment plans in and things like that. You know, if they can't pay it back, then the trustees do have to pull in this security. It's not something that is optional, and you know, we can just leave it. We do have to pull in the security. So if the company is in trouble, which it would have to be not to be able to repay the loan, do you then want the member to lose personal assets as well? It really is sort of, you know, putting everything into one basket. For that reason, we don't let people use their prime residence because we just think that's not the right. We never want to be in that scenario that somebody's losing the business and we make them lose their home as well. We have done it where we've used buy-to-let property or where we have used holiday homes. So where they are personally owned, as an example, that you could consider using. From the employer's point of view, we have also used plant and machinery in the past, but again, you need to be careful and really think this through and you know, be fairly confident that, you know, the security is never going to be called in, because if the business is struggling to pay the loan and then you take away their plant and security, obviously that's going to be reducing the chances of that business getting out of trouble if you're just taking away, if it's plant and machinery that's vital to the business operating. So yeah, care is needed on these. If you use taxable property, which residential property or plant and machinery both would be, then there's unauthorised payments to consider as well. So at the point the charge is put in place, the only unauthorised payment is in relation to any payment made in relation to that charge being put in place. So there's normally no consideration for actually that charge going into place, but there are fees associated with it. There will be legal fees to put that charge in place. So if the pension scheme, if the SSAS pays those fees, that would be an unauthorised payment, and there would be tax charges on it. You can avoid that by the company, the sponsoring employer, paying those fees. So as long as they pay it, then there's no unauthorised payment at the time the charge is put in place. So that's okay. Obviously, the problem is if we ever have to call in that security, because at that point, once that is called in, the pension scheme then has an interest in that taxable property, and that will lead to whatever an unauthorised payment charge in relation to whatever the market value of that property or asset is, which means so you're going to lose. So, you know, you're going to have the value of that property, but also there's going to be another chunk coming out of the pension scheme in relation to unauthorised payments. So again, caution really needed, and you want to be very confident that the business isn't ever going to be in that position, because, you know, the consequences of it are quite significant. So wants just to be careful on that one. The test for the security being enough to cover the loan and the interest is only a one-off test at the point that the loan is taken out. So if the asset later drops in value, and so it's worth less than the loan, that doesn't create an unauthorised payment charge. That isn't an issue at that point in time. Next on the list then for loan backs is interest rates. So HMRC have stimulated that the minimum interest rate is calculated by reference to 1% above the average of base lending rates of 6 leading high street banks. Those ones specified there, and then it's calculated rounded up to the nearest multiple of 0.25%. It's also the same rate that is charged on unpaid corporation tax self-assessment, and it's on HMRC's website. And since the 7th of April, it's been 2.6%. That's including the 1% above. So the minimum, if you were taking out a SAS loan back now, would be 2.6%. If we're doing it on a fixed rate, it can be fixed or variable, the rate of interest on it. There is no maximum rate. However, it does have to be commercial. So there are circumstances where if you have a cash-rich sponsoring employer who may want to take out a loan and pay large amounts of interest because they can have it as a tax-deductible business expense, and it's a way of getting money into your pension scheme, which doesn't count towards the annual allowance, and obviously has all the advantages of that money being in a pension scheme. Yeah, we have to be a bit careful that we're not doing things like that, trying to avoid the rules. So I mean, our company view is anything which is more than 3% above base, so at the moment would be at more than 4.6%. We would have to review that. We'd want evidence that that was commercial and that was the best thing, that you could get. Yeah, we would be a bit wary about that, because you do have to be careful that we're not doing any sort of avoidance rules. We want to get around things, even though there's not a absolute maximum stipulated anywhere in the rules. Next up, we have the term for the loan back. So maximum of 5 years. If you put anything over 5 years, then it automatically becomes an unauthorised payment. Rollovers are allowed where the sponsoring employer gets into genuine difficulty with making the repayments. Under normal circumstances, we would need evidence of those genuine difficulties. So we would need to see the company accounts, information from the company accountant before the rollover could be granted. At the moment, there is a relaxation from HMRC, given everything that's happened this year. So there was a temporary relaxation until the 31st of March 2021, which means that scheme administrators are allowed to grant rollovers without seeing that evidence, on every time, just because the sheer volume of them. And I think when this relaxation was first introduced, a lot of accountants and people weren't working, and schemes and companies were just closed up, obviously, in the initial lockdown. So when they first introduced that. When a rollover is granted, it can only be granted once. You can't keep doing this indefinitely, and your security can continue. So as I mentioned, even if it's gone down in value, or if it doesn't cover all of it or anything, that's not an issue in itself. That doesn't create an authorised payment. It's not reassessed. It just continues. Maximum amount of the loan is fairly straightforward, 50% of the net scheme assets at the date of the loan. And again, if you make a loan and then the other assets in the scheme drop in value, and so you're above the 50%, the loan's more than 50% of the scheme assets, that's not an issue. It's just a one-off test at the time. If you come and want to take a second loan further down the line, so part way through your first loan back, then you will, when you're doing the 50% assessment, you have to obviously deduct the value of your existing loan, so you have a maximum of 50% loan at any point in time. If you're close to the 50% limit, then we would need to have all the assets in the scheme revalued, obviously, just to make sure that that's not exceeded. So the repayment terms then. So we have to make, again, HMRC rules state that you have to make at least equal instalments of capital and interest for each year of the loan, and the required amount to be repaid is calculated at the end of each year as, and this is a formula that HMRC give us. So we have the loan amount plus the total interest over the 5-year period, if it's up to 5 years, however long it is, divided by the number of loan years, and you times that by the number of loan years in the period that you're looking at. So as an example here, if we have a £100,000 loan taken out for 5 years and total interest over the period is £15,000. Just a note on the interest. I've done an example here based on it being a fixed rate of interest. You can have a variable. It can be variable as well, but easy to sort of demonstrate with a fixed rate of interest. HMRC rules then state that in the first year, you have the loan of 100,000, 15,000 total interest over the period, divided by 5 years, the loan years. In the first year, the minimum payment, it will be £23,000. You can pay more than that, that's fine, it's just that's the minimum. Then at the end of the second year, the total minimum repayment will be 46,000. So if you've overpaid in year one, say you pay 30,000 in year one, then you don't need to pay 16,000 in year two, as long as, you know, at the end of each period you've paid at least the minimum amount. Now, in practice, it may be worked out slightly different by your provider, say, especially if there's variable rates, they have slightly different methods, but as long as those minimums are met, then you are within HMRC rules on that. Another I suppose investment opportunity, whatever you want to call it, for SSAS that sometimes get quoted is about investment in company shares. So there are rules in Pensions Tax Manual, if you look at it, or in the legislation, that state that occupational schemes, which of course SSAS is one, can invest in shares of the sponsoring employer. And you can use a maximum of 5% of the scheme assets in each sponsoring employer, up to a maximum of 20% of scheme assets overall, because you can have more than one sponsoring employer. It's not something, I'm not sure if I've mentioned that already or not, but I should have mentioned it, yes. So as an example scenario, if you have a husband and wife who both have their own companies, they can have one SSAS, both of those together, and both companies could be sponsoring employers. So one employer would have to establish the scheme and then the other employer would join it, but they would both be classed as sponsoring employers, and so they would both have opportunities for making loan backs to each of them. That would be fine. And in theory, and I'll explain why I'm saying that in a minute, then the maximum of 20% of scheme assets can be used to invest in all the sponsoring employers. And there's no limit on the amount or the percentage of the company shares held. However, big caveat on this. We still have taxable property rules that we do have to worry about. So, as I'm sure most of you are aware, if a pension scheme invests in residential property or tangible movable property, anything you can pick up and touch, with the exception of investment grade gold bullion, but there you go, then it's an unauthorised payment if that's within a pension scheme, and there's horrible tax charges that apply to that. This also applies if you have an indirect holding of taxable property, which will be the case if the pension scheme member, if a pension scheme buys shares in a company that holds taxable property and the member has control of that company. Now, control will be either a controlling director, where they own 20% or more of the shares themselves personally, via their pension scheme and any connected person to them, e.g. a spouse, or if they are a shareholder that own more than 50% of the shares. Now, in a SSAS, pretty much every time, by their very nature, they are going to be the business owners and they are going to have control of the sponsoring employer, with very few exceptions. If they control the assets of that company, that means if they buy shares in that company, they are going to have an indirect holding of taxable property. Now, there are some exemptions some of you may be aware of, that if assets are worth £6,000 or less, and they are used for the management and administration of the company, then you can disregard it. So it won't be classed as an unauthorised payment, this indirect ownership of such assets. However, that's just to be very rare that that's going to be the case, because for an asset, any company is likely to own some assets, even if it's a mobile phone and a laptop. It's a fairly basic thing that pretty much most companies are going to own, even if they don't own anything else. Now, They could be worth less than £6,000, but the problem is whether they are used exclusively for the management administration of the company with no personal use. And I think it's very difficult. You're ever going to be able to guarantee that you don't have any personal use of those items whatsoever, in which case the exemption doesn't apply. It's just a minefield. So really, we don't allow it via, SSASs that we look after, and I'd be very cautious of any other SSASs that do it. I think this is a prime example of where you look at the rules and you think, yes, you could do that, but actually there's another set of rules somewhere else, which means actually it doesn't work in practice, that if you have a SSAS scheme, say there's no requirement for a professional trustee or scheme administrator on it, but if you don't have somebody who has that experience, how it would be very easy for members running their own scheme to fall foul of the rules and inadvertently do something that ends them in trouble with unauthorised payment charges and tax charges from HMRC. And by having some professional company provider involved, they're going to help you avoid these kind of issues. Last subject matter to look at is transfers then. So as I've talked about already, it's a lot longer process setting up a SSAS. You can, once the SSAS is established, you can transfer other pensions into a SSAS in the usual way. I will say that actually in the past, SSAS has had a lot of bad press when it comes to scams and things, because they have been vehicles that have been used by scammers, which means that some providers obviously are a lot more wary about transferring to SSAS. And to be fair, if somebody transfers out from us to a SSAS that we don't know, it's not with a recognised provider, then we will ask a lot of questions as well. Obviously, if you're transferring to somebody with a well-known trustee practitioner involved, then it's probably going to be a lot smoother. But expect to be asked more questions is my point. There are changes coming following the pension schemes bill currently going through Parliament in terms of the statutory right to transfer and what schemes can ask for. Because these are occupational schemes, there are likely to be rules coming where you have to prove the employment link, and a lot of schemes are already asking for that. So if you have a sponsoring employer, don't be surprised if the scheme you're transferring out from into the SSAS wants evidence of the employment link between the member transferring and the sponsoring employer. So in terms of like sort of 3 months pay slips, that kind of thing. So yeah, just want to be aware of. EPPs, executive pension plans, they can remain intact and be assigned to a SSAS, which is another advantage of them. You can't do this normally with SIPPs. So what this means, obviously, a lot of EPPs will have guarantees in them. So you might have protected PCLS, you might have guaranteed annuity rates. Yeah, so you don't want to lose that. Obviously, if you transfer it, you will lose some of the benefits from it. If you actually assign it to a SSAS, effectively you have the SSAS wrapper around the EPP. So you keep all those benefits, but the advantage of that is if you are wanting to fund a property purchase, or you're wanting to make a SSAS loan back, is that if it's an asset of the SSAS, it will count as an asset when you're doing your calculations for the maximum 50% borrowing, if you're borrowing to purchase property, or if you are wanting to make a SSAS loan back. You have that as an asset of the pension scheme of the SSAS, so that can be quite useful at times. When it comes to transferring a SSAS itself, you can't transfer a SSAS as such because it is the scheme set up by the employer. So obviously individual members are still free to transfer out in the usual way, but if you decide for whatever reason you don't like your current provider, be it the acting as trustee, administrator, practitioner, or not at all, you don't have any of those, you don't do a transfer of the scheme itself. What you can do is do a takeover. So you can change the professional trustees on it, or add professional trustees if you don't have one existing. So any existing trustees can, non-member trustees can resign. You can appoint a new professional trustee. You can change the scheme administrator on it. So the scheme itself stays intact, and so you just have a takeover, which can make things a lot easier because it's not actually a transfer. As I mentioned before, If you sell the business and you want to get rid of the employment, the link with the employer, that's fine, you can do that. You can appoint a new sponsoring employer if you want to. If you sell one business, the member sells one business and starts up a new business, you can put a new sponsoring employer on it. So there's a bit more flexibility, but it is a little bit different in terms of what you can do than with a SIPP. Okay, just to finish off with a quick summary then. On the SIPP side of things, SIPPs are, as the name suggests, a personal pension, individuals. SSAS is an occupational pension scheme established by an employer. A SIPP is usually on a master trust basis. There are some contract-based SIPPs, and short SIPPs contract-based can be out there. But usually with a SIPP, you have one master trust that's already in existence with the scheme rules, and when the member joins an arrangement. Whereas a SSAS it's an individual trust, as in it's a trust per scheme, not per individual, because you have multi-members in the scheme. On a SIPP, you have separate arrangements for each member, whereas with a SSAS, it's pooled between that trust for that employer. When it comes to property purchase on a SIPP, you can form a group of SIPPs, and then the property is held between them normally on a joint tenants basis. So if it's split 60-40 and one member dies and they own 40% of that property, that will go to their beneficiaries, and so that property would have to be, or maybe they might want to take it over and own it jointly with the remaining individual, or they may have to sell it, or the other person buy them out, or whatever. You'd have to have that agreement. Whereas with a SSAS, the property would be an asset of the SSAS. You could have, they say on death, you could have a beneficiary join as beneficiary member. So there is still an option of transferring out assets. Doesn't necessarily have to be from the property, it could be from any assets, because you can take it from wherever you like within the SSAS. SIPP can't make loans to connected parties at all, whereas a SSAS can make a loan to sponsoring employer if those certain conditions are met. Tax relief, SIPP's usually relief at source, SSAS is usually net pay. You can register for relief at source if required. There is extra administration involved in that. Both products are regulated. SIPP is by the FCA and the SSAS is by the TPR on that. So that is all from me. I'm just put on the slide here, so we do have our platinum brand, so we do have SSAS available if you are interested. Those are the contact details there for our SSAS consultants. It's all on the platinum website if you want to get in touch, if you want any more information from any of those guys. But otherwise, I will just say thank you very much for listening, and I hope that's been of use to you. Thank you.